So the third quarter is now effectively behind us. That was last week, Friday, and we're just looking at another Friday tomorrow, the first Friday in October, and as we kick off the fourth quarter of the year 2017. So let's step back a little bit. Let's piggyback, as it's been said. I'm being joined this conversation here in the studios by Peter Moses, who is one of the research analysts at Kodos Capital. Good morning.
Good morning, boss.
Thanks for coming. You folks like writing, as I said, off camera, very lengthy report. It says a monthly report. Yeah. Yes, very lengthy. And of course, we getting through to Michael Famuroti, who is the economist at Vetiva Capital Management. Is joining us via Skype from downtown Lagos. Michael, thanks for sticking by with us on this show and for this part of the conversation as well.
Pleasure to be here.
Thank you. I haven't seen your report again, but Michael, let's start with you. What defined the third quarter for you? Some says we weren't bearish, we weren't bullish, but we were burning.
Well, in terms of the markets, I think it was a relatively good quarter. There was a bit of zigzagging, but overall the market was up. And if you look across the sectors, especially the banking sector, things were generally positive. I think because we had seen the initial push in the second quarter, especially in May and June, there was a much stronger pace, and it's unsurprising that momentum weakened a bit. But I do think it was a relatively good quarter. I think that the quarter was definitely buoyed by relatively okay macroeconomic news. So whilst inflation was still sticky and that sort of deterred people a little bit, we saw that the country officially came out of recession at the end of the second quarter. We've seen relatively stronger oil prices in the third quarter as well. Production has come back up, and in terms of some of these sectors, we've seen improvements in earnings, especially across the consumer and industrial goods names, as energy challenges have subsided and we've seen more stability in the FX markets. I think those were the key drivers for Q3. And like I said, overall, I do think it was a relatively good quarter coming off a very strong end of Q2.
So Michael believes it was a very relatively good quarter. Is that your conclusion as well, Peter?
Yeah, looking at where we're coming from a Q2 that was very strong, very robust. If you look at the equities market, for instance, the ASR return as high as 30% in the second quarter of the year. And then in the third quarter, which just ended, it actually, returned a little above, just around 7%. What you would attach that to is quite very obvious and simple. You had a very strong second quarter, and then you have a third quarter that is just coming. If you look at the fundamentals that drove the market in the second quarter of the year, which was, basically the I&E FX window and more clarity in the macro space, you would have expected that strong gains, investors would ordinarily want to take profits on that, and that's how you saw the market, extremely, also bullish, but then returning very lower compared to what we saw, we had in Q2. Then in the fixed income space, what you had was a case of investors trying to play in that space compared to what happened in the equities market. If you're taking profit in the equities market, it is just expected, for instance, you want to reinvest, and then you want to look for extremely high yields as well. And if you look at that space, the fixed income space, for instance, that particular quarter, what you will see is that you had relatively improved system liquidity. You had inflation, as Michael has said, still, fairly benign, though, moderation has been a bit lower than expected. And then you saw the MPC consistently guiding towards the fact that rate cut is on the horizon, pointing to the fact that policy consistency at that monetary policy level is clear. So then investors found that respite, and then you look at, especially at the long end of the curve, you saw yields remaining extremely high. If you compare the Q2 performance in fixed income space with the Q3 performance, for instance, Q2 was bearish, both for the T-bills market and also the bonds market, but was bullish in Q3.
Yeah, but again, I'm seeing about 200 basis points trend, a little bit lower in fixed income, bills and bonds in the third quarter as we begin to wrap up September.
Okay, for September, basically, the performance was also positive. As we reported in our reports. Going forward, for instance, you still want to see same thing. But then, talking about how well would yield, continue to moderate, I think it's basically a function of outlook for the interest rate environment and what inflation outlook is going to be like. For the remaining part of this year, our inflation outlook is basically going to be driven by what happens to food prices. We've seen harvest, season coming up. We just reported concerning the rice, price. What the farmers have actually reported is the fact that output as far as rice production is concerned is robust compared to where we are coming from. And if you add that to the fact that for most of other food products and agri products, you expect a relatively stronger harvest compared to last year. Though we've had cases of flooding around most places, Benue is there and all of that, but you still want to have comfort in the fact that what you have in terms of harvest is going to be, relatively buoyant compared to where you're coming from. And then if you link that to the fact that our inflation rate, and I look at the tone of the Monetary Policy Committee, which has gathered to the fact that between now and Q1 2018, you could see a rate cut. We want to continue to see, yields trend lower, but of course, not very aggressively.
Michael, let's come to you on this. I'm looking at this report, and I'm looking at total foreign portfolio transactions in September. Increased 244%. Aggressive foreign investors coming into this market. And you listen to Peter here talking about, yes, the I&E window. Do you think that the strong rally that we saw April, May, June, July is beginning to taper out and the I&E window we're technically done, as it were?
No, far from. I do think the window is working well. I think the recent volumes, especially in September, are suggestive of that. I think he mentioned the fixed income markets and how the yield outlook is downward there. Then what we saw in September was an anticipation that rates are probably going to trend down in the next coming months. So there was a lot of demand to lock in rates, both from domestic and foreign participants in that market. And I think that's something that may filter in through to some parts of this month. Yields are still relatively attractive, especially whilst the Federal Reserve hasn't properly kicked off its reverse QE program. So there's still going to be activity in the NAFEX market, and it's still very much a barometer of the health of the wider FX market. And again, when you look at rates convergence between that market, interbank, and the parallel market, it's suggestive that is a pretty good signal of where market prices are selling right now. And I still expect a relatively good month in October for the FX space. And I think that's going to be driven partly by still good demand in the fixed income side. We hope to see more joy as on the equity front, although in the last month or so, we've seen a lot of mixed trading. Yeah. You've taken us into the fourth quarter, so let's get you analysts' views on the outlook. Today we got it was published, the rights issue of Guinness Nigeria, oversubscription there, and we have quite a number of others still coming through. We had Lafarge Africa and all that. You see the strong buying into Lafarge shares in the last week or two. How much of this do you think will play into the fourth quarter from the corporate side, from the fundamentals of investors, and looking at the pricing of these stocks that are coming to the market, PZ, UACN, Lafarge Africa, and the rest, who are very aggressive in terms of, including a few insurance stocks, who wants to have additional shares in the market, additional fundraising? Michael. Yeah, I think no one's really surprised about the level of primary market activity we've seen in the last couple of months. The Guinness rights, for example, is a great case study because we saw a huge arbitrage opportunity between the primary market and the secondary market in terms of the rights price and the secondary market trading price. And because of that, there's really no surprise that the rights issue was so successful. It's a trend that is likely to persist. Maybe not to that same extent, but we definitely see the likes of WAPCO, UBN, some of the insurers as well that you mentioned. There is relatively healthy demand in the primary market space for these issues because valuations in the secondary market compared to the start of the year are much healthier. And I think as that continues for Q4, that's probably going to drive a lot of activity in these stocks. And for the insurance sector in particular, it's probably going to drive sector activity there.
Peter, squeezing the right issue conversation here and some of the other themes that you think should be in focus for the new quarter we're just entering.
I think we need to look more at the wider economy and also look at the performance of companies that are listed on the Nigerian Stock Exchange, for instance, to know, have a very good understanding of the outlook for the remaining part of this year, that's fourth quarter. If you look at the third quarter, for instance, the leading indicators that we have that we can really lay hold on is the PMI. It would be nice to mention that the PMI data for the third quarter of the year, for instance, on a quarterly basis, average, we are the highest we've ever seen. As far as the CBN data can point us to for manufacturing, and the highest level we've seen since Q4 2014 for the non-manufacturing sector. This is in addition to the fact that consumer expectation, business expectations are extremely strong at this time compared to around this time last year. And if you look at companies that are listed, especially for consumer goods company, you look at industrial goods company, and also look at the banking sector. For consumer goods companies, it's a positively changing story, which speaks, comes from the backdrop of the fact that consumers' pockets are extremely better compared to around this time last year. If you look at inflation, as I've said earlier, quite relatively improving, prices and stable prices. So if you put all of this together, you expect better earnings, which is going to drive performance for this particular quarter, and of course, the full year 2017. Same thing for banking stocks, and continue to see the same thing. Since we have, as I said earlier, for the fixed income space, for instance, foreign investors are beginning to come back in. The I&E FX window turnover has consistently remained on the increase, but then you see turnover in the equities market, declining. So we expect that will continue to play out in the fixed income. So for fourth quarter, we want to see a market, both equities and fixed income market, that will still be relatively positive for investors.
Michael, I'm coming back to you. Some of our viewers watching this conversation are sending some messages in via social media and saying, look, that this market is, our market is relatively small, still elementary, and investors from outside can easily see through the market and take advantage of the market and of the economy. How much more sophistication do you think we need to get here to increase local participation vis-a-vis foreign participation? What do you need with the team? We need more products. We need to re-engineer things from the regulatory side, or from the securities trading platform side, or from the issuer side.
I think it's from all angles, to be honest. The market has made significant strides in the last couple of years. I think NSE and SEC have done a great job in terms of trying to push the market forward. Obviously, in terms of returns, it's not been a very good period on the equities front, so that's probably dampened participation a little bit, especially because people are still reeling from being burnt about 10 years ago. But in terms of the infrastructure that's driving the market forward, we have seen improvements. It's something that has to continue. If you look at our market capitalization that floats between 10 and 12 trillion naira, that's a relatively small part of the wider economy, so there's a lot of room to grow. Generally, Nigeria does not have a particularly strong savings culture, and as we address that, perhaps through things like the federal government savings bond and through education and poverty reduction, naturally we're going to see more participation in the capital markets. But obviously, the regulators, issuers, and everybody involved, even from the demand side, everyone has a part to play in ensuring that this market gets deeper, but it also gets more sophisticated in terms of the products available and in terms of how trading is done as well.
Peter, finally, speak to us on this particular issue. What sophistication would you want to see from the market?
Well, for a market that's relatively young compared to more advanced economies, what you would want to see is the participation of foreign investors. To actually deepen the depth of the market, and that will also go. That will have to flow back to the fact that the wider economic space has to, be improved upon. You have to see policy consistency both from the fiscal authority and also from the monetary authority. Yes, we have market regulators that come up. regularly to give policies, to give regulations as to ensuring that market activities are in line with global standard practices. But you have investors outside your country that are consistently looking at how things are being run at both the fiscal level and monetary level. If policies are not consistent, if investors are not having that confidence in the economy, at all those levels, as much as you have those policies from the regulators, you really would not have the impact feed through the market on a wider ground. So I want to see the macroeconomic space leading the chart as far as the market depth is concerned.
Would you like to see more product sophistication?
Oh, definitely. Our market is, as far as product sophistication, if you look at one of the major factors that are used in rating markets globally, as far as Nigerian case is concerned, product sophistication and availability is actually one of the things that has dragged us so behind. If you look at advanced markets, US, for instance, both across markets, fixed income, FX, for instance, equities, a whole lot of things that you should see, derivatives and the likes are currently not here. But of course, I want to believe that that's just because of the fact that even the ones we have, so you have to develop them much more beyond this before you step up, step into further into new products.
Peter, thank you very much.
Thank you so much.
For being here. Peter Moses from Quadros Capital. And of course to you via Skype, Michael Famuroti, economist at Vetiva Capital Management. Thank you very much, gentlemen, for sharing this conversation with us.